The relentless churn of financial markets often leaves a trail of frustration and depleted capital, a harsh reality for countless traders who struggle to navigate its unpredictable currents. Many enter the trading arena with aspirations of wealth, only to find their dreams eroded by emotional decisions, insufficient planning, and, most critically, a fundamental misunderstanding of risk management. The single most common culprit behind sustained losses, the silent destroyer of trading accounts, is the absence of an effective, disciplined approach to stop-loss orders. Traders frequently fall prey to the illusion that they can outsmart the market, attempting to ride out losses in the fervent hope of a reversal, only to witness their capital dwindle to unsustainable levels. This pattern of neglecting protective measures transforms potential minor setbacks into catastrophic failures, undermining confidence and ultimately forcing many out of the market entirely. But what if there was a timeless methodology? A set of principles so robust that they could transform your approach to risk, turning stop losses from a dreaded necessity into a bulletproof shield for your investments? Today we delve into the profound wisdom of one of the greatest market minds in history, William Gann, a legendary trader, analyst, and forecaster whose insights into market cycles and human psychology remain strikingly relevant even a century later. Gann's legacy is built not just on his uncanny predictions, but on his unwavering emphasis on capital preservation and disciplined risk management. His rules, often considered esoteric in their deeper applications, offer surprisingly straightforward and incredibly powerful guidance on the most critical aspect of trading: managing your downside. We are not just talking about placing a stop-loss. We are talking about integrating a philosophy that fundamentally alters how you interact with risk. In this video, we will unveil 5 of William Gann's foundational rules, specifically tailored to help you implement bulletproof stop-losses. These aren't mere suggestions. They are indispensable pillars designed to safeguard your capital, minimize your losses, and fundamentally shift your trading trajectory towards sustained profitability. Prepare to arm yourself with the wisdom that has guided generations of successful traders, enabling you to stop the bleed and build a truly resilient trading strategy. Rule 1. Always use stop-loss orders. William Gann unequivocally stated that a stop-loss is not an option, but a mandatory instrument for every trader who wishes to survive and prosper in the markets. This principle lies at the very core of responsible trading, serving as the first and most critical line of defense against unforeseen market movements and the inherent volatility of financial assets. Its fundamental significance cannot be overstated. A stop-loss order is designed to limit potential losses on a trade to a predetermined acceptable level. Before you even contemplate entering a position, you must define the maximum amount of capital you are willing to risk on that particular trade, and then set your stop-loss accordingly. This isn't merely a technical instruction, it's a psychological safeguard. Without a preset stop-loss, traders are left vulnerable to the most dangerous forces in the market: their own emotions. When a trade moves against you, fear can paralyze rational thought, leading to hesitation and inaction. Hope, a powerful but often destructive emotion in trading, can tempt you to hold on to a losing position in the desperate expectation of a reversal, often leading to significantly larger unintended losses. A stop-loss removes this emotional burden, forcing an exit at a logical, predefined point, thereby preserving objectivity and preventing panic-driven decisions. It acts as an automatic circuit breaker, preventing a small, manageable loss from spiraling into a devastating blow to your trading account. Think of it as an insurance policy for your trading position. You hope you never need it, but you're profoundly grateful it's there when you do. The primary goal of any trader, above making profits, should be capital preservation, and the stop-loss is the most direct tool for achieving this. It ensures that no single trade, no matter how wrong your initial analysis might have been, can wipe out a significant portion of your capital, thus allowing you to live to trade another day. In practical application, The placement of a stop loss is paramount. Gann insisted that a stop loss must be placed before opening any trade as an integral and non-negotiable part of your comprehensive trading plan. This preemptive action ensures that your risk is quantified and accepted before any capital is committed. The determination of a logical stop-loss level should always be based on objective technical analysis, rather than arbitrary percentages or gut feelings. For instance, common methods include placing stops below key support levels for long positions, above resistance levels for short positions, or using indicators like average true range ATR to account for an asset's historical volatility. The idea is to find a point where, if the price reaches it, your initial trade thesis is invalidated, signaling that you were wrong and it's time to exit with a controlled loss. This disciplined approach eliminates the guesswork and emotional reactivity that often plague inexperienced traders. For example, if you are entering a long position, a logical stop might be just below the most recent swing low, as a break of that level would indicate a shift in market structure that negates your bullish outlook. Conversely, for a short position, placing it just above a recent swing high offers similar protection. The key is that the stop-loss level should make technical sense, not just represent a fixed dollar amount. A common counter-argument often voiced by frustrated traders is, "My stop-loss always gets hit just before the market reverses." While this can be an incredibly disheartening experience, Gann's philosophy provides a crucial perspective. He would argue that such occurrences are part of the game and highlight the importance of discipline over the futile attempt to perfectly time the market's absolute bottom or top. Being stopped out means your initial premise was, at least temporarily, incorrect. Holding on to a losing trade in the hope of a reversal, without a stop loss, is a far greater risk. It exposes your capital to unlimited downside, and the emotional toll of watching a significant loss grow can be paralyzing. Gann's approach emphasizes that accepting small, controlled losses is a fundamental component of long-term profitability. It's about preserving capital to participate in the next, more favorable opportunity, rather than clinging to a losing position and risking catastrophic financial ruin. The market does not care about your hopes or your predictions. It simply moves. A stop loss is your commitment to adapt to that movement, even if it means admitting a temporary defeat. It is a testament to the fact that even the most seasoned traders are wrong frequently, but their success stems from how they manage those wrong decisions. Rule 2. Protect accumulated profit by moving stop loss. Building upon the foundational principle of always using a stop loss, William Gann further emphasized the critical importance of protecting accumulated profits by strategically moving your stop loss order. His thesis was clear and compelling. Never allow a profitable trade to revert into a losing one. This rule marks a sophisticated evolution in risk management, shifting focus from merely limiting initial losses to actively safeguarding gains as a trade progresses in your favor. The core concept here is often referred to as a trailing stop. As the price of an asset moves favorably, the stop-loss order is adjusted upwards for long positions, or downwards for short positions, to lock in existing profits or at least move the trade to a break-even point. This transforms a potentially risky venture into a free trade once your stop is moved to your entry price, eliminating the initial capital at risk. Gann understood that the market is dynamic, and profits, while encouraging, are only realized when they are protected. Letting a winning trade turn into a loser is not just financially detrimental. It's a significant psychological blow that can erode confidence and reinforce bad habits. The deep analysis of this rule reveals several key stages and objectives. Initially, once a trade has moved sufficiently in your favor, perhaps when the profit equals the initial risk you took, a 1-hour move, the first logical step is to move your stop loss to your entry price. This immediately removes any risk to your capital for that specific trade. From this point onward, any further movement in the desired direction allows for subsequent adjustments. As the price continues to advance and reaches significant new price levels or technical milestones, e.g., breaking through a major resistance, establishing a new swing high, the stop loss can be moved further into profit territory. The goal here is twofold. Firstly, to fix a portion of the already gained profit, ensuring that even if the market reverses sharply, you walk away with a guaranteed gain. Secondly, it is to eliminate the risk of losses on what was an already successful trade, reinforcing positive trading psychology and disciplined profit-taking. This continuous adjustment mechanism ensures that you are always managing your exposure and actively participating in the market's upward or downward trend, while simultaneously shielding your capital from unexpected reversals. It's about being proactive in managing your success, rather than passively hoping for continued gains. In practical application, there are various methods for effectively implementing a trailing stop. One common approach is manual adjustment, where traders visually identify new key levels of support for long trades or resistance for short trades as the price progresses. For instance, if you are long and the price breaks through a significant resistance level and then pulls back to retest it, establishing it as new support, you might move your stop loss just below this newly confirmed support. Similarly, if the market forms a new swing low after a significant upward move, that swing low becomes a logical place to trail your stop. Automated trailing stops are another powerful tool offered by many trading platforms. These can be set to move automatically by a fixed percentage, a fixed number of pips points, or based on an indicator like the average true range ATR. For example, an automated trailing stop could be set to always remain 2 ATRs below the highest price reached since entry. This dynamic protection ensures that your profits are continuously safeguarded without constant manual intervention, allowing you to focus on other aspects of your trading or even step away from the screen. However, a common counter-argument against aggressive trailing stops is the risk of being shaken out of a position prematurely due to minor market fluctuations or normal retracements. Traders sometimes fear that by trailing too closely, they miss out on larger gains if the market simply pulls back momentarily before continuing its trend. Gann would acknowledge this concern but emphasize the importance of understanding the specific asset's volatility and choosing appropriate trailing parameters. A highly volatile stock might require a wider trailing stop than a stable currency pair. The key is to find a balance. A stop loss that is tight enough to protect significant profit, but wide enough to allow the trade room to breathe within its natural fluctuations. This requires careful observation, backtesting, and a deep understanding of the instrument you are trading. The goal is not to capture every single pip of a move, but to consistently capture substantial portions of trending moves while minimizing the risk of giving back hard-earned profits. It's about intelligent profit management, not perfect market timing. The principles of William Gann, while rooted in the early 20th century, continue to provide an invaluable framework for understanding market dynamics and trader psychology. His emphasis on discipline and logical risk management over emotional speculation is a timeless lesson. For those who seek to delve deeper into the foundational texts that shaped modern trading thought, and to understand the very roots of technical analysis and market psychology, there are resources that can illuminate this path. One such resource, a classic work by Gann himself, is Truth of the Stock Tape. This book, a testament to his enduring insights, explores market cycles, the psychology of speculation, and the underlying principles that govern price movements. While some of the original charts within the book might reflect the technical limitations of their era and appear to be of poor quality by today's digital standards, the textual content itself is an absolute gold mine. It offers an unparalleled glimpse into Gann's mind, revealing the systematic approach he took to the markets and his unwavering focus on the core tenets of trading. If you are serious about mastering the foundational elements of market behavior and the disciplined mindset required for success, exploring Truth of the Stock Tape is an essential step. It provides context, depth, and practical lessons that resonate even today, reminding us that while technology evolves, human nature and market principles remain constant. You can find more information and acquire this seminal work through the link provided in the description below. Rule 3. Never average a losing position. This rule from William Gann is perhaps one of the most psychologically challenging for traders to adhere to, yet its violation is a direct path to financial catastrophe. Gann's thesis was stark and uncompromising. Adding to a losing position is a strategy doomed to failure, a dangerous gamble that dramatically escalates risk without any corresponding confirmation from the market. The allure of averaging down, buying more of an asset as its price falls in the hope that a small rebound will bring the entire position back to profit, is a powerful, deceptive siren song for many traders. It appeals to the human desire to be right and to avoid admitting a mistake, masking its inherent danger with the illusion of reducing the average cost. The deep analysis of this rule reveals why it is so perilous. When you add to a losing position, you are effectively doubling down on an initial assumption that has already been proven incorrect by market action. The market is sending you a clear signal. Your initial analysis, your entry point, or your direction was likely flawed. Instead of heeding this signal and accepting a small, manageable loss, averaging down increases your exposure to a deteriorating situation. This exponentially magnifies your risk as your capital commitment grows while the market continues to move against you. What was initially a small, acceptable risk on a single position quickly transforms into a significantly larger, uncontrolled risk across a much larger position size. This practice often stems from the sunk cost fallacy, where traders become emotionally invested in their existing losses and are unwilling to cut them, believing that by adding more they can somehow fix the situation. This is a cognitive bias that often leads to throwing good money after bad. Gann understood that true capital preservation means focusing on accepting small, predefined losses and moving on to new, more favorable opportunities, rather than engaging in desperate attempts to get even or average out a bad trade. The market is an unforgiving arena. It does not reward emotional stubbornness, only disciplined adaptation. In practical application, adhering to this rule means rigidly sticking to your initial stop loss and exiting the trade promptly when that level is reached. There should be no hesitation, no second guessing, and absolutely no adding to the position. Once your stop is hit, the trade is over. It's a clear signal that your initial premise was incorrect, and the most prudent action is to preserve your remaining capital. After exiting, the focus should immediately shift to reviewing your initial analysis, understanding where you went wrong, and then searching for new, higher probability trading opportunities. This disciplined approach ensures that your losses remain small and manageable, allowing your capital to stay intact for future endeavors. It fosters a mindset of continuous learning and adaptation, rather than one of stubborn resistance to market realities. For example, if you bought a stock at $100 with a stop at $95 and it falls to $95, you exit. You do not buy more at $90 hoping it will bounce to $95, because now your risk is larger and your capital is tied up in a losing venture, preventing you from deploying it elsewhere. The counter-arguments often involve strategies like martingale or other averaging techniques, which are sometimes presented as viable methods for recovering losses. These strategies advocate for increasing position size after losses, theoretically guaranteeing a win eventually. However, Gann would vehemently reject such approaches due to their inherently high risk. While they might occasionally work in specific scenarios, they carry an exponentially increasing risk of catastrophic ruin. A long enough losing streak, which is an inevitable part of trading, can quickly deplete an entire trading account, regardless of its size. These strategies are fundamentally incompatible with Gann's principles of capital preservation and controlled risk. They prioritize the attempt to be right or recover losses over the paramount goal of protecting capital, often leading to a single, massive loss that wipes out all previous gains and then some. Gann's wisdom teaches that small, frequent losses are a cost of doing business, but large, uncontrolled losses are the death knell of a trading career. Rule 4. Risk only a small part of capital on one trade. This principle, though seemingly straightforward, forms the bedrock of truly bulletproof stop losses and, more broadly, sustainable trading success. William Gann's thesis was clear: proper capital management is not just a good idea, it is the fundamental prerequisite for longevity and profitability in the markets. Without it, even the most astute market analysis and perfectly placed stop losses can fail to protect your overall capital from the inevitable drawdowns. Gann was emphatic in his recommendation, suggesting that a trader should risk no more than 1/10 of their total capital on any single trade. While modern risk management often translates this into a 1 to 2% rule per trade, the underlying principle remains identical. Position sizing is the direct control mechanism over your exposure. The deep analysis of this principle reveals its profound impact on a trader's survival and psychological well-being. The size of your position directly influences the magnitude of your potential loss when your stop loss is triggered. If you risk too much on one trade, even a perfectly placed stop loss can result in a significant capital reduction. For instance, if you risk 10% of your capital on a trade and hit your stop, that's a 10% drawdown. A series of just a few such losses can quickly decimate an account, making recovery incredibly difficult. Conversely, if you risk only 1 to 2% per trade, even a string of 5 to 10 consecutive losses, which are statistically probable over a trading career, results in a manageable 5 to 20% drawdown, leaving ample capital to recover and profit from subsequent trades. This conservative approach is not about limiting your potential for profit. It's about ensuring your survival on the market. The ability to endure a series of losing trades without suffering catastrophic losses is what separates successful, long-term traders from those who quickly wash out. It provides the psychological buffer necessary to continue trading objectively, rather than succumbing to fear or desperation after a few bad trades. Gann understood that the market will always present challenges, and only those with robust capital protection can weather the storms and capitalize on opportunities when they arise. Your primary objective is to stay in the game, and small position sizing is the most effective way to do that. In practical application, determining the correct position size is a crucial calculation that should be performed for every single trade. It involves three key variables: your total trading capital, the percentage of capital you are willing to risk per trade, e.g., 1% or 2%, and the distance from your entry price to your stop-loss level. For example, if you have a $10,000 trading account and decide to risk 1% per trade, your maximum risk per trade is $100. If your technical analysis dictates a stop-loss 50 cents away from your entry price, you would then divide your maximum dollar risk, 100, by the stop-loss distance, 0.50, to determine your position size. $100 divided by 0.50 equals 200 shares. This calculation ensures that, regardless of the asset's price or volatility, your actual capital at risk remains constant and within your predefined limits. This methodical approach ensures that your stop-loss isn't just a price point, but an integral part of a comprehensive risk management strategy that protects your overall portfolio. It empowers you to confidently enter trades knowing that even if you are wrong, the financial impact will be contained and non-threatening to your long-term trading career. The broader historical context of Wall Street, filled with booms and busts, legendary successes and spectacular failures, offers a powerful testament to the timelessness of these principles. Understanding the psychology of markets and the strategies of historical figures like William Gann and others who navigated these turbulent waters provides invaluable lessons. For those fascinated by the rich tapestry of financial history, the stories behind the major market events, the financial crises that shaped economies, and the remarkable individuals who left their indelible mark on the trading world, there is a resource that brings these narratives to life. I'm talking about the YouTube channel Wall Street Memoirs. This channel offers a captivating journey through the historical events, the financial crises, and the extraordinary personalities that have defined Wall Street. It's a place where you can gain a deeper appreciation for the cyclical nature of markets and the enduring human elements that drive them. elements that Gann himself so keenly observed. By exploring these historical perspectives, you can better understand why principles like disciplined capital management are not just theoretical constructs, but practical necessities proven over generations. It provides a rich backdrop to the timeless wisdom we are discussing today, reinforcing the idea that while the tools may change, the core lessons of market behavior and risk remain constant. Dive into the fascinating world of financial history and deepen your understanding of the forces that shape our markets by checking out Wall Street Memoirs. You'll find a link to their channel in the description below. A common counter-argument to risking only a small percentage of capital is the perception that low risk equals low profit. Traders, especially those new to the market, often feel that they need to take larger risks to achieve significant returns quickly. However, Gann's philosophy emphasizes that consistent, sustainable growth is achieved through capital preservation and compounding small, consistent gains. While a higher risk per trade might lead to larger profits in isolated instances, it also dramatically increases the probability of catastrophic losses and ultimately account blow-up. There is a critical balance between preserving capital and allowing for growth. The goal is not to eliminate risk entirely, but to manage it intelligently, ensuring that you can survive the inevitable losing streaks and capitalize on winning opportunities without ever putting your entire trading career in jeopardy. Small, consistent gains, compounded over time with prudent risk management, invariably outperform aggressive, undisciplined approaches that are prone to large drawdowns. It's about playing the long game, not chasing short-term thrills. Rule 5. Never cancel a stop-loss order after its placement. This final rule from William Gann is arguably the most crucial for cultivating the psychological resilience and unwavering discipline required for long-term trading success. Gann's thesis was absolute. Once a stop-loss order has been placed, it must be treated as inviolable. To cancel or move a stop-loss against your position after it has been set is an act of profound indiscipline that almost always leads to significantly larger, often catastrophic, losses than originally planned. This rule directly confronts the most dangerous trap in trading, the trap of human emotion. When a trade moves against a trader, fear, hope, and denial can create an almost irresistible urge to just move the stop a little further, believing that the market will surely reverse. This impulse is the enemy of a systematic approach. The deep analysis of this rule exposes the insidious nature of emotional trading. Canceling a stop-loss is rarely a rational, objective decision based on new, material information. Instead, it is typically an impulsive reaction born out of fear of realizing a loss or the desperate hope that the market will turn around. This act fundamentally undermines the entire risk management framework that was carefully constructed as part of the trading plan. By removing the predetermined exit point, a trader effectively opens themselves up to unlimited downside risk. What might have been a small, controlled 1% loss, if the stop-loss were honored, can quickly spiral into a 5%, 10%, or even a 50% loss as the market continues its trend against the position. This not only decimates capital but also inflicts severe psychological damage, making it harder to trust future trading decisions and leading to a vicious cycle of fear and poor performance. Gann emphasized that adhering to a predefined trading plan is paramount. The plan, including the stop-loss, is formulated when the trader is in a calm, objective state of mind, free from the emotional pressures of an active, losing trade. Deviating from this plan under pressure is a sure recipe for disaster. In practical application, this rule demands a level of psychological fortitude and unwavering commitment to your trading plan. The placed stop-loss should be considered sacred and unchangeable, unless there are objective, predefined reasons for adjustment, such as moving a stop to protect accumulated profit, as discussed in Rule 2. These adjustments, however, must be part of the original pre-planned strategy, not impulsive reactions to adverse market movements. For example, if your plan states that you will move your stop to break even once the price moves 1 hour in your favor, that is a planned, objective adjustment. But if the price is heading towards your initial stop and you suddenly decide to widen it because you feel it will reverse, that is a violation of this rule. Developing the ability to accept losses, no matter how painful they may feel in the moment, is a crucial skill for any successful trader. It requires a profound shift in mindset, viewing losses not as failures, but as the predefined cost of doing business, a necessary component of a probabilistic strategy. This acceptance frees you from emotional attachment to any single trade and allows you to maintain objectivity across your entire trading portfolio. It is the ultimate test of discipline. The primary counterargument to this rule often revolves around the idea of adapting the stop loss to new information, or giving the trade more room to breathe. While market conditions are dynamic and a trading plan should indeed allow for flexibility, Gann would stress the critical distinction between objective, predefined adjustments and emotional, impulsive alterations. If new, objective market information genuinely invalidates your original stop-loss placement before it is hit, and your trading plan accounts for such scenarios with clear rules for adjustment, then a change might be permissible. However, such instances are rare and must be clearly defined in your plan. The vast majority of stop-loss cancellations or widenings are driven by fear and hope, not by a reasoned, objective reassessment. They are an attempt to avoid a small, known loss in favor of an unknown, potentially much larger loss. Gann's wisdom teaches that true adaptation comes from analyzing past trades, refining your plan, and improving your entry-exit strategies, not from abandoning your protective measures in the heat of the moment. The discipline to honor your stop-loss even when it feels uncomfortable is a cornerstone of long-term success and capital preservation. It is the ultimate expression of trust in your own strategy and commitment to your financial well-being. In summary, William Gann's timeless wisdom offers a clear, powerful roadmap for navigating the treacherous waters of financial markets. His 5 foundational rules for bulletproof stop-losses are not just theoretical concepts. They are practical imperatives for any trader committed to long-term success. First, always use stop-loss orders, treating them not as an option but as an indispensable tool for limiting potential losses and preserving objectivity. Second, protect accumulated profit by moving your stop-loss, strategically adjusting it to lock in gains and transform profitable trades into risk-free ventures. Third, never average a losing position, recognizing that adding to a losing trade is a high-risk gamble that exponentially increases exposure and is a direct path to ruin. Fourth, risk only a small part of your capital on one trade, understanding that proper position sizing is the ultimate safeguard for your overall portfolio and ensures your survival through inevitable drawdowns. And finally, never cancel a stop-loss order after its placement, upholding the sanctity of your predetermined exit point as a testament to your discipline and commitment to your trading plan. Implementing these principles requires more than just intellectual understanding. It demands unwavering discipline, consistent practice, and a profound psychological shift. It means accepting that losses are an inherent, unavoidable part of trading, and viewing them as small, manageable costs of doing business rather than personal failures. It means prioritizing capital preservation above all else, recognizing that staying in the game is the ultimate prerequisite for long-term profitability. By diligently applying these rules, you will not only minimize your losses, but also cultivate the mental fortitude and strategic approach necessary to thrive in the volatile world of trading. These are the lessons that have stood the test of time, guiding generations of successful traders. Now it's your turn. Apply these powerful rules from William Gann to your own trading. Transform your stop-losses from mere technical orders into an impenetrable, bulletproof defense for your hard-earned capital. Make discipline your unwavering ally and watch as your trading trajectory shifts towards consistent, sustainable growth. The path to becoming a truly resilient and profitable trader begins with mastering these fundamental principles. For those eager to delve further into the profound psychology and strategies of legendary traders, beyond the insights of Gann, there's another timeless classic that offers invaluable lessons. Reminiscences of a Stock Operator, a new edition of the iconic work by Edwin Lefebvre, provides a deep analysis of the psychology and strategies of Jesse Livermore. This isn't just a reprint, it's a meticulously enhanced version, featuring insightful comments and analysis accompanying each chapter. It transforms Livermore's incredible, often tumultuous trading experiences into practical, actionable lessons for today's market participants. Just as Gann's rules emphasize discipline and risk management, Livermore's story, as retold and analyzed in this edition, underscores the critical role of market psychology, self-control, and the relentless pursuit of understanding market movements. It's an indispensable resource for anyone serious about mastering the mental game of trading and learning from the triumphs and failures of a true market titan. Discover the expanded wisdom and practical insights waiting for you in Reminiscences of a Stock Operator. You can find the link to this essential read in the description below.